It begins like any other morning. No alarms, no warnings, no collapse on the news, just a quiet, ordinary day. Until something feels off, you reach for your phone, open your banking app, and there it is, your balance. Intact, every dollar accounted for. Every digit exactly where you left it. Nothing is missing. And yet, something is wrong. You try to make a payment. Maybe it's something small. A coffee, a subscription, a transfer. Decline. You pause. You try again. Declined. A message appears. Cold, neutral, almost emotionless. Transaction not permitted. Not insufficient funds. Not a technical error. Not a network issue. Permitted. As if your money now requires permission. You stare at the screen, trying to process what just happened. Because this breaks something fundamental, something you've believed your entire life. That money, once earned, is yours. But what if it never was? What if money was never ownership, but access? Access that could be granted, or quietly taken away. For centuries, money was simple, tangible, physical. If you held it in your hand, it belonged to you. No authority could reach into your pocket and decide how, when, or where you could use it. Cash was freedom, not because it was valuable, but because it was final. No approvals, no intermediaries, no invisible systems watching, recording, evaluating. But the world has changed. Money is no longer something you hold. It's something you're allowed to use. And that shift, subtle, almost invisible, is one of the most important transformations in modern financial history. Because once money becomes digital, it becomes programmable. And once it becomes programmable, it can be controlled. Not just tracked, not just taxed. Controlled. And that's where this story truly begins. There was no announcement. No global declaration that cash was over. No moment where the world collectively agreed to abandon physical money. Instead, it faded, quietly, gradually, almost politely. One tap at a time. At first, it felt like convenience. Faster checkouts, no need to carry wallets, no counting coins, just a card, a phone, a fingerprint. Then came the apps, seamless payments, instant transfers, money moving across the world in seconds, reduced to nothing more than data flowing through invisible networks. And people embraced it. Because humans are wired for efficiency. We trade complexity for simplicity, friction for speed, and most importantly, we often trade long-term control for short-term comfort. But beneath that convenience, something deeper was happening. Cash wasn't just being replaced. It was being removed. In countries like Sweden, cash transactions have dropped to near extinction. Entire stores, restaurants, even banks, no longer accept physical money. Not because they can't, but because they choose not to. And when a system stops accepting something, it slowly stops existing. But here's the part most people don't think about. Cash is the only form of money that exists outside the system. When you hold cash, there is no intermediary, no database, no approval layer. It is a direct, peer-to-peer transfer of value. But digital money, that's different. Every digital transaction passes through a system, banks, payment processors, clearing networks. Each layer adds convenience, but also dependency. And dependency creates vulnerability. Because if your access to that system is interrupted, even temporarily, your money becomes unreachable, not gone. Just inaccessible. And this is where we need to understand something critical. Digital money is not the same as physical money. When you deposit cash into a bank, you are not storing it. You are lending it. Legally, that money no longer belongs to you. It becomes a liability for the bank, essentially an IOU. What you see in your account is not your money sitting in a vault. It is a promise, a digital representation of value, backed by trust. And trust, as history has shown us, is fragile. Because the moment trust is questioned, systems begin to crack. Banks can limit withdrawals. Governments can impose controls. Transactions can be delayed, flagged, or denied, not because the money disappeared, but because access was restricted. Now imagine a world where there is no cash alternative. No escape from the system. No physical fallback. Only digital money. Fully integrated, fully monitored, fully controlled. At that point, money doesn't just lose its physical form. It loses its independence. And when money loses independence, what happens to yours? For most people, money feels simple. You work, you earn, you save. And whatever sits in your bank account, that's yours. Or at least, that's what you've been taught to believe. But the truth is far more unsettling. Because the moment you deposit your money into a bank, something fundamental changes. Legally, that money is no longer yours. It becomes a liability for the bank. Let that sink in. When you see a number on your screen, your balance, you are not looking at stored wealth. You are looking at a promise. An IOU, a digital agreement that says, the bank owes you this amount, but the money itself, it's no longer sitting there, waiting for you. It has already been used. This is where the system reveals its true nature. Modern banking operates on something called fractional reserve banking, a system so normalized, most people never question it. Here's how it works. When you deposit $1,000 into a bank, the bank is not required to keep all of it. Instead, it keeps a fraction, sometimes as low as 10%, sometimes even less. The rest, it gets lent out. To businesses, to borrowers, to mortgages, to the economy. That same $1,000 gets duplicated into multiple layers of debt and credit. It becomes $5,000, $10,000, sometimes more, circulating through the financial system. And this is how money is created, not printed. Created through lending. Through trust, through a system that depends on one critical assumption, that not everyone will ask for their money at the same time. Because if they do, the illusion breaks. This is what we call a bank run, a moment when people collectively realize something uncomfortable, that their money isn't really there. And when that realization spreads, even the strongest institutions can collapse. But here's the deeper question. If your money in the bank is just a promise, then what do you actually own? And more importantly, what happens when that promise is controlled? We like to believe the financial system is stable. Structured, regulated, secure, a system designed to protect us. But history tells a different story. Because every few years, sometimes decades, the system reminds us of its true nature. Fragile. In 2008, the world watched as major financial institutions collapsed. Banks that once seemed untouchable suddenly faced bankruptcy. People lined up outside branches, desperate to withdraw their savings, not profits, not investments. Their own money. And many couldn't. Because when too many people demand access at once, the system doesn't have enough liquidity to respond. Not because the money vanished, but because it was never fully there to begin with. And governments, they step in. Not always to protect individuals, but to protect the system itself. Sometimes, that means limiting withdrawals. Sometimes, it means freezing accounts. Sometimes, it means enforcing capital controls, restricting how much money you can move, spend, or even access, not as a punishment, but as a measure of control. Now think about that. A system where your financial freedom can be temporarily paused for the sake of stability. And most people accept it because it's framed as necessary. But necessity has a way of expanding. What starts as a temporary restriction can evolve into a permanent capability. And this is where psychology plays a dangerous role. Because humans adapt quickly. We normalize restrictions if they are introduced gradually. We accept control if it comes packaged as protection. And over time, what once felt unacceptable becomes standard. Now imagine combining this fragile system with a new kind of money, a system where every transaction is digital. Every movement tracked. Every action recorded. And most importantly, every permission controlled. No need for bank runs. No need for physical lines. Because control no longer requires panic. It can be executed silently. Instantly. At scale. And once that system is fully in place, the question is no longer whether your money is safe. The question becomes, do you still have control over it? To understand where we're going, we need to understand where money began. Because money was never supposed to be this abstract. It wasn't always numbers on a screen, or promises backed by institutions. It was something real, something tangible. Gold. For centuries, gold was money, not because governments said so, but because people trusted it. It had value in itself. It couldn't be printed. It couldn't be manipulated easily. And most importantly, it couldn't be controlled by a single authority. If you held gold, you held wealth. No system, no intermediary, no permission. But gold had a problem. It was heavy, inconvenient, difficult to transport. So banks offered a solution. Deposit your gold with us, and we'll give you paper notes. Those notes represented your gold. You could trade them instead of carrying physical metal. At first, it worked perfectly, because every note was backed. Every promise was real. You could walk into a bank, hand over your paper, and receive your gold. No questions asked. But then, something changed. Banks realized something powerful. Not everyone came back for their gold. So they started issuing more notes than the gold they actually held. Slowly, quietly, strategically. And just like that, the system shifted from asset-backed money to trust-based money. This was the birth of modern finance, and over time, governments took control of this system. The final break came in 1971, when the United States, under President Richard Nixon, officially ended the gold standard. From that moment, money was no longer tied to anything physical. No gold, no silver, no int. Subscribe, or stay in the dark. Subscribe, stay ahead.